Taxes, it's something we all deal with and probably have a question or two about. This week on Money in Your Pocket, CPA Matt Cekander from Doring Winders & Company will be here to answer a variety of common tax questions, from what type of form to use, deductions, credits, and how to handle an IRS audit. We've got a lot of useful information just ahead, so don't go away.
This program is made possible in part by Credit Union One. Proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunion1.org. Loans subject to approval. Accounts are insured up to $250,000. By member's choice, this institution is not federally insured.
Well, today on Money in Your Pocket, it's all about taxes, and I have a CPA in the studio with me, Matt Cekander. Thank you for joining us.
Well, glad to be here.
Tell us a little bit about where you work and what you do.
I'm a CPA licensed in Illinois. I work for Doring Winders & Company. It's got 4 partners there. I've been there since 2006. I've been with them, and that was after leaving the Chicago area back in 2001. So about 13, 14 years doing public accounting in total.
All right, and you're down in the Effingham office, correct?
I'm out of the Effingham office. I spent some time in Mattoon as well.
All right, well, thanks for coming up today to talk to us about taxes, something that we all have to deal with and we all have lots of questions about. First easy question, who actually needs to file income taxes?
Who actually needs to file? Probably the easiest way to answer that is if you're single and someone else can claim you, you should be looking to file as you get around $6,000. Mm-hmm. That's that first standard deduction amount. That's $6,000. If you're earning more than that, you should probably be filing or asking somebody for some help. Do I need to file?
Okay. So let's talk about, as a CPA, you probably have lots of friends who ask you questions, and I know you see a lot of clients. What are some of the biggest mistakes you think people make when it comes to taxes?
The biggest mistakes is mathematical errors if they're trying to try them on their own.
Uh-huh.
The software packages and some of the ones that are out there have cut down on the mathematical errors. IRS will actually correct a lot of those, so it's not that big of a deal, other than it starts to attack the credibility of the overall return itself. But that is one. Probably not asking for help or being embarrassed to ask for help if they get an IRS notice, or if there's something on you move beyond a basic W-2 and some interest and dividends, something like that, like a K-1 from a business, and you're not too familiar with it, you should probably get some help at that point.
Okay. I have to ask, do you ever have clients that bring in their receipts in a shoebox?
Does
that still happen?
We've had a few, and I don't know if it's by their joke or if that's their system.
It's really their method.
It is. It runs the gamut with organization, and that's just one of the things you have to know what to look for and work with. But taxes, like anything else, you have all walks that you get to see.
We're going to talk a little bit later about organization and record keeping, but we want to talk about just some common terms that I want you to explain. We hear exemption, deduction, and credits. So let's start with those three.
Okay.
Get ourselves going.
Exemptions, that refers to how many people you'll be claiming on the return. So if you got a husband and wife, 2 kids, you will have 4 exemptions in that case: the husband, the wife, and the 2 kids. Assuming they meet the dependency test, they're in the house. There's a separate list that you go through there. Now those work similarly to deductions, and what that refers to is that's taking down your income before you calculate your tax. So the deductions are as good as your tax rate on them. If you're in the 15% tax bracket and you've got a $1,000 deduction, it's going to save you about $150.
Okay.
Now credits, those are the ones that have a little more meat to them. Those are dollar for dollar. If you've got a $1,000 credit, like the child tax credit, something in there, that's dollar for dollar that's going to come down that tax that you owe. So if you had a choice and they were $1,000 deduction or $1,000 credit, you would take the credit.
Okay. So the standard deduction seems to go up every year? Or down, up, down,
yes.
Like your standard deduction?
Yeah, the standard deduction is, they've been tying it to inflation, it seems like.
Okay.
Single is just above 6,000. Married filing jointly is a little over 12,000, and then the other filing statuses fall in there. And I think that is something that will continue to go up, and that's what you compare when you're doing your itemized deductions for your real estate taxes that you pay, your mortgage interest, charitable contributions, non-reimbursed business expenses. Those are itemized deductions, and you compare and you say, okay, if married filing jointly, you look at the $12,000, $12,400, and say, okay, do I have those other items that I could deduct? Does it exceed that amount? And should I take those itemized as well?
So if that exceeds that amount, then you go for the itemized.
Then you would do the itemized deductions, right?
All right.
Right.
So explain the 3 different basic tax forms that you use, and how do you decide which one to use?
Okay. The 1040 EZ is the basic one. The 1040A and the 1040. So 1040A is in the middle. The 1040, anyone can file a 1040. Okay, it's got. I was looking at this recently. There's almost 80 lines. I think it was 79 lines on that form. 2 pages. Instructions are a little over 100 pages. And to bring you to the other side of the spectrum, on the 1040 EZ, you've got around 14 lines and 40 pages of instructions. So you see complexity difference just right in there. Again, anybody can do the 1040, but if you have less than $100,000 in the income, and the only credit maybe you're going after is earned income credit, I think that's the only one that can be done on the 1040 EZ. And you just got the W-2, very basic, then you can do the EZ. Otherwise, it'd be the 1040A and 1040, and that would just be determined by what deductions or credits are you eligible for. Okay.
So you just get all your tax stuff together. Hopefully you get it all together. What kind of records should we be keeping throughout the season, so when it comes time to prepare our taxes, either ourselves or by a CPA, should we have to make it organized? And
to make it organized, well, I could stand to be more organized. Everybody could be more organized. The thing that I like to start with is what is, if I were to be audited by an IRS agent, what would they be looking for? The burden of proof really seems to rest on the taxpayer. So if they come in, they pull your bank statements, they look at all the deposits, they're going to say, okay, this is all taxable income, unless you can prove that it was a gift or someone filed a gift return. Okay, that's less than the $14,000 gift amount, so that's what that is. So you need to have your record supporting, no, this is taxable income, or no, this is a gift. On the other side, they're going to look at all of the deductions and say those don't exist unless you can prove that they do. So you really need to be thinking, looking at it from their lens, the IRS's lens, and saying even a credit card statement, trying to back up your expenses. That might show that you gave to XYZ charity, but they don't know that was to XYZ charity for some services or some materials that you purchased from them. They need to see it's for no goods or services were provided. Okay, now it's a bona fide 501c3. That's a legitimate deduction.
So how long, should you keep tax records? Just say the copy of your return, your W-2s, everything that you use to prepare the 2014 tax statement. How long, you as the CPA, would you keep it?
Well, we recommend in general, and a lot of the things we're talking about, I should bring up our generalities because everything's circumstance dependent.
Right.
But in general, 7 years is going to be what you should keep something for. Statute of limitations normally is 3 years, but the IRS can go back 7 years and indefinitely if they suspect fraud. So if you've omitted, even if you've omitted more than, I think it's 25% of your income, they can go back indefinitely if they suspect fraud. But you could have some situations where you're selling stock and you need to go back further than 7 years to substantiate how much you paid for that. You need to hold on to those records almost forever until you do something with the stock. Same thing on equipment, large pieces of equipment, if you're deducting that in your business. Some properties, if you own some properties, real estate properties, things like that. You need to hold on to those indefinitely or forever. And then when you get out of the business, maybe 7 years plus then.
So hang on to that stuff. If you've got room, better to have it than to be trying to find it later when you've maybe got the IRS breathing down your neck.
Well, and it shows the IRS that you did file.
Right.
So that was one of the things that you've always got the proof. Hey, I did file this return, and for some nostalgia reasons that you've got your returns going back.
That's true. What did you say you wanted to prove to your kids that at one point you made?
Yeah, so you can show them at one point you made $3 an hour and you were happy with it. So you can pull that up.
All right, let's talk about filing. Of course, we all know that April 15th is the filing. Do we have any advantages to filing our taxes early? If you got all your things together, can you file right away? Advantage?
You can. Probably the biggest advantage that comes to mind is just with everything we're hearing about tax fraud.
Yeah.
One of the things the perpetrators do is they file early because they know humans are what by nature? Procrastinators. Right. So then they're waiting on, okay, if I can get this thing filed ahead of time, then before the real person files a return, I can get that bogus refund. So by doing that, you cut that off. Another thing it does is it gets you, it helps with your organization, I believe, because the transactions happened, you're closer to that year end and you can recall and get your records together a little quicker. One thing you be careful with that, though, is make sure you've allowed adequate time. If you're expecting some 1099s and forms to come in, those might not be mailed to January 31st when they're required to. And now all of a sudden you file the first week of February, you get something in the mail, now you're stuck doing an amendment.
So what's the penalty if, I don't know, April, the deadline comes by and you got yours filed late? What do you do?
Well, there's a couple different things. It just depends on do you owe tax or are you getting a refund? If you're getting a refund, I hesitate to say this a little bit, but it's almost just like another date. It's just that you have 3 years to claim that refund.
Okay.
We've worked with some clients that hadn't filed in some years, and they sought us out for some help. They were due refunds in years 4, 5, and 6 back, and they were denied because they were outside the period, the statute of limitations. That 3 years goes on for the taxpayer as well. If you owe money, the best thing you can do is just get an extension in. Again, if you owe tax, though, you still need to make that good faith estimate on what you owe in taxes, or there'll be penalties and interest. You still got to pay it in. But that will give you 6 months until October 15th. And then you can get everything else. You still want to pay it as soon as you can to get the money in and stop the interest on amounts due. But I guess that's it just depends on if you owe or if you have a refund, what happens on April 15th.
Okay. What are some circumstances, we're talking not business owners, but just the general public, where you would maybe end up having a tax bill? What kinds of circumstances would create that scenario? Because no one wants to pay taxes, but we sometimes have to.
Yeah, and most people do pay taxes. They might not realize it because it's taking out incrementally out of their paycheck. One of the common reasons would be change in jobs, and you fill out everybody's favorite form, the W-4, and you've got that worksheet, how many exemptions, which is why I always advise, if you're not sure, go conservative and go less. If you're not sure, 3, 4 exemptions, go maybe 2, maybe 1. And then if you're married and you've got a spouse that works, check the married but withhold at the higher single rate. So that way it's not just based on your withholding at 15%. Now you're in the 25% or 28% brackets, and you've jumped up there. So that's a common issue, is not having the W-4s enough, and those can be updated throughout the year. That's not just a once a year. Get that changed if you owe in that situation. Okay.
What about your grandma died and left you a large sum of money?
Probably need to find out what's been paid, what tax has been paid on that. Has it gone through an estate? Was there an estate tax due? You could have to file a Form 706. Now those are getting up there where you've got a $5 million plus exemption on some of those, but they're generally speaking you wouldn't necessarily have to run it through the estate first. But you could have some things that never paid any taxes on any interest and dividends, depending on what is passing through to you as the beneficiary. So that's probably one of the questions you asked earlier. You probably want to ask somebody for some help if it's a significant dollar amount.
Okay.
That's right.
What about tax advantages? What are things that average Americans that can take advantage of?
Well, one of the things that comes to mind when you look at all the volumes of the tax code, it's been estimated, because there's no print. It's all a lot of it's online. 20,000, 100,000 pages of tax code. All of the credits, all of the deductions, everything that's in there, and it gets to be circular. Well, if you're not thinking about maybe you moved, well, there's a certain mile radius, but there's moving deduction that you might be entitled to. If you put in some made energy improvements in your home, depending on if it's the smaller one or solar or something like that, could be a more significant tax credit there. There's the retirement, the savers credit. There's a lot of things that if you're just kind of going through the forms, or the 1040-EZ, it's not even going to be on there, but the 1040, it will have on there that you could very easily miss or say, no, I don't think I get an additional child tax credit. Well, unless you're trained in that and you know what to look for, the questions to ask, very easy to overlook, again, all the credits that are there. I'll admit, I don't know every single credit that's out there either.
I'm sure not, because as you said, in your business, this tax law changes every year.
Right, lifelong.
Yeah. So what do you do if you realize, oh my gosh, I made a mistake on my tax return?
Depends on the type of mistake and the dollar size.
Okay, so if it's a minor mistake, say you did some freelance work and you forgot to include that income, and maybe it's $1,000 or something.
Well, generally something like that, you've got a 1099 that would be coming, because if it's over $600 for services, a lot of times you'll get the 1099 with it, and that's one of those where you can amend, or where are you at in the statute of limitations. You've got that 3-year window to then amend your return and correct it. But you also have to weigh into that. That's why I always ask the dollar size to see whenever you amend it, you need to do what's right. So if you didn't pick up that $1,000, something like that, you'll probably get an IRS notice saying you didn't pay this. We see this on here. And then of course, if they ever came in and audited and see that, they would ask for the taxes plus the interest and penalties on there. So I'm a proponent, especially if it gets up large enough dollar size, as soon as you can, because that's going to stop that interest and penalty accruing on top of that. And then if it's on the other way, you forgot to take a credit or somebody's looking at it, you get that 3-year window where you can amend, and then you might want to go back there and do that so you can take it, and then it works in the taxpayer's favor where IRS will pay you interest on that amount too. Okay, so
it can benefit you. It's
does.
Not always a negative.
Yes, I recently working with a client. There's another, $3,000 or $4,000, and we're going to amend a return from a previous year and do that.
But you only have, just so I'm clear, you only have 3 years. It can only go back 3 years.
It's 3 years from the date that it was filed.
Okay.
Generally, there's some exceptions to that, but right. So if you had a 2013 or 2012 return or something out there, you could go back and amend those. And I would advise doing that again if you're entitled to it and you're making the good faith effort that this is, I should have got this, then by all means, my advice would be to take that.
All right. So what happens if you do your taxes and you owe and you're just not in a financial position to pay that tax bill on April 15th? What options do you have?
Well, you become at the first thing I say is get it filed on time, send in the return, and stop the penalties from accruing on not the failure to file or not extend. And just send in as much money as you can at that point. Then what happens is in a few weeks, maybe 6 to 8 weeks or something, maybe sooner, depending on IRS, they will send a letter in the mail, because that's how they contact you, is via mail, that says you've got some tax due, we got this amount of the check, or there wasn't a check. You need to pay this dollar amount. So what do you want to do? Or contact us if you feel this is an error. Again, that's where communication is one of your best friends when dealing with the IRS. Don't get, if you want to go meet with somebody else, that'd be a good time to, if you don't have a tax advisor or CPA, look one up and do that. And that's one of the things where we can do that as a power of attorney and call and find out what's going on, or the taxpayer can. But just start that dialogue saying, what are our options? It's kind of case by case based on what you have, but they do have some installment programs that work out, and then based on what the dollar amount is owed, whether those are more burdensome or less burdensome. Okay,
well, let's talk about that awful word that no one ever wants to hear, and that's audit. That's a very scary. You don't mind that, but that's a very.
That doesn't mean I don't mind them. But they're.
It's a very scary thing. So. I want you to say this again, how does the IRS contact you if there's a problem that you're going to be audited?
The IRS will contact you via mail. If they don't hear anything else, you'll usually see follow-up notices from them. They've got the outside of the notice. I mean, you can tell it's a pretty official document that's coming through. It's never by phone, it's never by email, it's not by fax. If they show up at your doorstep, it's because you ignored all the mail, and that's just getting serious, okay? But by mail is how they'll contact you. And what happens is, most of the time, it will be a letter, a correspondence audit. Okay, there's two different types. There's the correspondence audit, which is the letter, and then the second one is the field audit, where they come out, dig through all your records. One could lead into the other.
Okay.
So the correspondence audit, they want to know something seems unusual, whether it was triggered by the IRS's computer system, that they won't tell anybody exactly how those work, but there's different triggers in there, red flags, things that are outliers to the rest of the data at large. And they will ask for the follow-up information that you then give them and say, okay, here's why we did this, or here's why we didn't do this, or yes, IRS is correct, and then you pay the difference. Or I've seen some notices come back saying, we think you're due a refund, you didn't take this, and they send them a check, which that's always a fun one to deal with, but that occurs too.
So again, it's important that you have all those documents to support that at that time. So you may be audited. I know you probably can't give us a laundry list of everything, but what are some general red flags that may trigger an audit? One of my personal views is that they've got some sort of benchmarking by taxpayer, and if they see something spike up that is unusual, maybe from year to year, whether you're a business, small business, or an individual taxpayer, where did that come from? That wasn't on the return in previous years, all of a sudden it's here, and it's a big dollar amount in relation to the rest of the return as a whole. What's that on there? I think there are certain triggers in there that do that. I also think that it's one of those items where there's been just a lot of issues, like the earned income credit is one of a lot of abuse seems to surround the earned income credit. They've been doing a lot of those. So if they're looking at what type of industry you're in and your income range and some things are changing there, that could trigger some, that's on their high alert area. Okay, but nothing, you can't say definitive, this will
cause
I won't put you on this one.
If you don't file your tax return and you've got 1099s, keep in mind, anytime you're getting those 1099s, what's on the others? Where'd the other ones go?
Right.
They went to the IRS, so they are waiting for your file, and they take the worst case scenario. So let's say you've got a 1099 of we'll use your $1,000 example, and you spent $800 on material, and $200 would have been the taxable income. IRS only has $1,000. They're just going to wait, and you're going to get a notice that says, here's $1,000 that you didn't pick up, you didn't file.
Okay.
You owe tax on the full $1,000. That's going to be their position at the highest. A lot of cases, it's the highest tax rate too.
Okay. So what should be your first course of action when the IRS contacts you via mail only? What should you do?
The first thing you do is that there will be a number on there. I would call. If you're having somebody help you with your taxes, I would call and just verify this sounds correct.
Okay.
And make sure that the CPA does that part of there, and then get on the phone number and log that communication with the IRS as soon as possible.
Okay. My last question, we've got about 2 minutes here.
Okay.
A lot of people do their own taxes, but at what point should you consider seeking someone in your profession, or tax preparer or tax professional, to help you with taxes?
That kind of goes with that question on the 1040EZ and the 1040. But if you have more than a W-2 and again, basic interest and dividends, things in there, you've got the K-1 flowing from a business as a business owner, and make sure you're not missing deductions, credits, and things that are on the table. Those are a great opportunity to have that discussion and get some professional help.
So the more complicated it gets.
Yes, more complicated it gets, and changes in something, going on to the Social Security and the income limits.
Okay, so we were talking about that. When you're getting ready, close to retire, that's things get complicated, or
yes, they can, because if you retire and start taking that Social Security amount before the full retirement age, you hit an earnings ceiling. It's $15,000. It's just under $16,000 this year. If you earn more than that, you got to pay it back in, and it just can get a little messy. Same thing on the required minimum distributions with investments.
Okay, so anytime maybe some big life changes happen, you move to another state, you get married, have kids, big investment,
right?
Death.
Those are, yes, and have those communications during the year with the CPA or tax provider. Don't wait until after December 31st when it's too late.
Yeah.
Have that when it's still in that kind of that gray area, planning area.
Okay, so plan ahead and keep good records and constant communication with your tax preparer.
That's right.
All right. Well, Matt, we're all out of time. It went so fast. I think we've got lots more questions for you. So that means we'll have to have you back on Money in Your Pocket.
All right.
The tax bottom line is the IRS will never contact you in person, by phone, or by email. It will always be via mail. Any other method should be considered suspect. Be sure to communicate immediately with the IRS if you receive an official document in the mail. Matt also recommends continual communication with your tax professional throughout the year. That way, you can make better tax and financial decisions. Anytime there's a change in your life, such as moving, marriage, death, retirement, your tax situation will most likely become more complex, and it might be a good time to seek professional tax advice. And finally, you want to show a good faith effort in anything related to taxes, from record keeping to deductions and credits. Remember, the burden of proof always falls to the taxpayer and not the IRS. Well, that's our show for this week. Thanks for watching, and we'll see you next time for Money in Your Pocket.
This program is made possible in part by Credit Union One. Proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunion1.org. Loans subject to approval. Accounts are insured up to $250,000. By member's choice, this institution is not federally insured.